Anup Maheshwari, EVP and Head Equities at DSP BlackRock, joins us on the show right now. Anup, it's great to have you in the studio. What's the call now for 2013? I mean, after a fabulous 2012, do you think the market is pretty much priced in the turnaround?
Well, clearly starting 2012, we weren't as optimistic, and things through the year seem to be slowing down further. I think we've been very encouraged and heartened by government action a few months ago, and I think that clearly has created a bit of a turn in sentiment, as well as in the underlying rate of deceleration in the economy, as it were. So from a phase where we were sort of heading downwards, I think it's now a lot more stable potentially, and that does give us confidence eventually for corporate earnings. Now it tends to come with a lag, so these things don't turn very sharply, but nonetheless markets will start discounting some of these events in advance. And we're getting quite optimistic on earnings growth, for 2014 and probably even more so for 15, assuming that at some stage, maybe post the elections, the capex cycle does start picking up a little more. So I've got to say we're a little more optimistic, clearly. And I think one very important catalyst that I've been mentioning again and again on your show as well is we'd like to see interest rates start moving lower, because that does act as a even stronger catalyst for a re-rating of the market. So the earnings growth itself will help, but an interest rate lower downward trending profile will help equity valuations even further.
Is it Anup, again, good having you, of course. Is it, I mean, the last 2 months at least, if we see, it's really been the macro action by the government which has kind of at least led to the change in sentiment for the equity markets as well. Do you believe that the next leg up, as and when it happens, I'm assuming that you're bullish on the markets, do you believe that the next leg up would essentially come in from core factors like an interest rate cut or earnings growth coming in, or do you believe that further government activity would actually provide that initial stimulus for the markets to probably even cross new highs?
I think it's more fundamental. So it's earnings growth and interest rates that will be the key driver eventually of markets. Government action is more sentiment driven, frankly, and as I said, they've it's sort of at least completed a phase where confidence was seemingly actually coming down. I think we've crossed that hump at least, so that's pretty positive.
Do you think the market returns have already priced in a series of rate cuts?
No, I don't think so, not yet.
Okay.
And I think there's still a fairly divided opinion in terms of whether we're going to see rate cuts in the next few months or maybe even a little later. But my sense is I think from an international context, India continues to look reasonably decent. And if earnings growth starts picking up, next year, of course, we've got a lot of election talk and all of that. So, it's not going to be a very smooth ride, clearly.
Sure.
But I think on balance, you'd have to start getting a lot more positive on equities now. And an interest rate cut would be a very strong catalyst for that.
In 2013, which are the top 3 sectors to your mind as investment destinations, essentially?
I think clearly the biggest sector in India still remains financial services, and that's going to be very important in the overall performance of the market. And especially if you have hopefully rates beginning to come off, and I think the worst of asset quality coming slowly to an end. I think banking will continue to be an interesting area to focus on. Besides that, there's some smaller peripheral sectors, media clearly, and retail to some extent. I mean, these are very small sectors, frankly. They're not big weights in the index. But logically, over a 2-3 year period, there should be larger weights and higher market capitalization being generated out of these sectors.
And you think the build-up will start from this year onwards, where people will actively start allocating more money to these sectors?
Well, yeah, I mean, people will allocate whenever they feel like. We're positive generally on the fact that profitability in these 2 sectors will start improving. I think you will have clearly, there's a fair amount of value that has been created already, which I think will start getting more and more recognized over time. So our feeling is, there are very few companies in these sectors, but it definitely warrants, some degree of investigation and coverage so that over time, as things start improving, one doesn't miss out these themes.
You were talking about rebalancing within banks. Do you think the time to kind of reallocate to or buy PSU banks has come purely on the basis of value?
Yeah, I mean, they're definitely in the cheap zone. So it's something that you have to start looking at. Having said that, private sector banks continue to deliver fairly consistent rates of growth and remain, long-term very secular stories or investment opportunities. So I guess you'd sort of want to add, I guess, to public sector banks as well, just on a pure valuation basis, but not necessarily funding it out of only private sector banks. So in a sense, you'd have to stay overweight on the financial services sector overall, which is what we're doing.
What about the commodity space? Because there are a few people who argue for and few people who argue against there being a rally in the stocks, essentially, not necessarily the commodities, because there are various opinions out there. What do you do here with, say, ferrous metals, non-ferrous metals? Because these stocks are not exactly trading at some new highs. They're probably very close to their lows, if at all a few bucks off their lows. What do you do here?
Well, these companies, I mean, businesses obviously haven't done very well, and we've always seen long-term that when you buy such businesses below book value, you end up doing well. Eventually, you make good returns whenever an economic cycle comes back. It does look like you have to be a very patient investor in that segment today, because it's not like an economic cycle is going to come back right away. So in the near term, we'd still see the sector as more of a trading sort of sector. There is sort of a sense that with improvements coming through in China, there will be a rub-off effect for commodities generally. So from a purely short-term point of view, there could be some interesting things to look at there. But I think from a longer-term point of view, it's going to sort of take a while. But as long as excuse me, companies are below book value, I think it always makes sense to keep an eye out on that sector and identify good investment opportunity.
The other one, Anup, would be cement, and I just wanted your view. I mean, if at all you're even remotely bullish on cement, what happens in that space? Because large caps are trading at premium valuations, mid caps are trading at, I mean, if you take a simple EV per ton, they're not exactly trading at their highs. They're trading at fairly low valuations compared to large caps. Election year spend may be coming into play, economic cycle revival if you're talking about that. Do the mid caps play catch up to the large caps, or do you believe that there could be a movement both ways, wherein the large caps, because they're trading at premium valuations, might also come down a bit?
So the challenge for that sector is that it's already done extremely well, and pricing power has been really strong so far, and valuations are pretty much to some extent reflecting that. So I guess one has to be very convinced on the pricing power continuing for a fairly long period of time.
Are you?
To take a call. So we are definitely invested in some cement companies. I wouldn't generalize it across the sector, but there are a few names that in particular we like, which is what we will buy and hold. But I think for the sector as a whole, I think pricing is the critical factor to track clearly. And our senses right now, it does look like, the overall, we've got to look into it early next month, because right now prices have been a little weak in the short run. But I think if prices remain even where they are, these companies will generate fairly healthy profits, and to that extent, you will probably see okay performance from the sector. But the sort of, you've got to be a bit careful considering the fact that valuations are pretty stretched. So any slight negative is something that you need to just keep on your radar.
If you're looking at rate cuts going forward sometime in the year, then is the time to look at engineering companies, cyclicals, infrastructure companies from a valuation perspective right now? Is the time right now at the start of the year in anticipation of a turn in the investment cycle somewhere down the line?
So the investment cycle will probably take a little longer to come through. Again, it's quite well known by now that the government is fairly actively encouraging public sector companies to either invest or pay out dividends. So there you will see capital investment starting clearly, or a push towards that by the public sector companies. But the private sector still has time to go. So that's not going to happen, in our opinion at least, for another year. So therefore there is still time for that whole investment cycle to pick up in big measure, and for that to start reflecting into profitability of such companies. So we're I'd say on the infrastructure, core infrastructure names, we're still a little cautious. But clearly on the engineering side, there are, again, it's very bottom up, this market, as you've noticed for the whole of this year. So there are clearly some names that you'd still be very positive on. And you know that whenever, the cycle turns, there are fairly significant returns that you can make from some of these businesses. So wherever there's a core return on capital employed that even in a down cycle is maintained at a base level, we're looking at those sort of names.
What about defenses? What about FMCG, pharma companies, which everybody knows, has been the story for 2012? Does one look at bargaining for some risk with the high beta names of the cyclicals and reduce exposure to consumers in 2013, or you think that weightage would largely remain the same?
Yeah, well, to be honest, I wish it was as simple as just defenses versus cyclicals, but it doesn't exactly work that way, although we talk about it that way. The fact is it's very bottom up, it's very specific company by company. I'd have to say, just to generalize it,
there is an overall allocation, right?
Yeah, from our point of view, I'd say there's a slight tilt towards, companies that will benefit from lower rates, interest rates. So, for instance, within our consumer space, and consumption continues to be a great long-term theme, but within the consumer space, let's say we would have reallocated a bit from consumer staples towards consumer discretionary. So, consumer discretionary would be things like auto, media, etc. And auto in particular is sensitive to interest rates. So, we have a slightly heavier position in consumer discretionary versus consumer staples, which are perceived to be much more defensive. But the overall consumption allocation is still fairly decent.
So, Anup, just about time, but since you're speaking about this being largely a bottoms-up market, I can't get you to talk about stocks. Are there themes that you believe in general would rise? Sure enough, within that particular theme, there will be some stocks that will do better and some stocks which will probably not do as well. But is there a theme in general? Broadcast media could be it, or distribution companies could be it. Is there a particular theme that you think could be a winner in 2013?
Yeah, well, I'm not sure there's a broader theme, but at a sector level, there are definitely opportunities. And, from our point of view, I've mentioned a few already. I think wherever we can see sort of more pricing power coming into a sector or valuation creation in the form of recognition of asset valuations. So, for instance, real estate, for instance, media, for instance, retail and media, not real estate. But in the retail front, we clearly see, there's a lot of investment that has occurred, and hopefully people recognize that. And similarly, in the case of media, profitability will gradually keep increasing because of the ability at some stage to influence pricing power, we think. So wherever there is pricing power available, in sectors, those are the areas that will tend to do a lot better.
There is some pricing power coming in real estate as well.
Yeah, I guess real estate, again, very, very stock specific. Our biggest challenge in real estate is that the return on capital ratios of real estate companies are still subpar. One of the most profitable companies in that sector still has only a 12%, let's say, ROE. So that becomes a bit of a challenge for long-term investors in terms of trying to buy businesses that have a base economics in place. But, there will be specific companies that, at a price definitely makes sense to look at.
Great, Anup. Thanks so much for taking the time out and joining us.